All right, that's RBI Governor Shaktikanta after the Monetary Policy Committee meeting announcing key decisions. And the key decision, of course, is that repo rate remains unchanged at 6.5%. Kartik Malhotra here with me in the studio. Kartik, good morning.
Morning, Shweta.
This was in line with expectations. Run us through the key takeaways.
In line with expectations, the repo rate is unchanged. The key policy rate unchanged at 6.5%. Growth forecast for FY24 unchanged at 6.5%. We are looking at CPI inflation, the new projections by RBI coming in for FY24 at 5.2%, well above RBI's required threshold of 4% inflation. And even the next financial year, FY25, inflation projection is kept at 5.2%. So I think any talks about a rate cut, any expectations on a rate cut seem like a far cry right now, which means we are going to be in this elevated, rate cycle for some time to come. We don't know when RBI will finally bite the bullet of cutting rates, because inflation also, as RBI Governor Shaktikanta just pointed out, you will see inflation easing out, because this inflation has been high in the month of July and August on the basis of high vegetable prices, right? Food prices, the spike that we saw in tomato prices, the spike that we have seen in cereal and pulses as well, have kept overall retail inflation fairly high and elevated. Now, those prices are likely to ease in coming months. RBI Governor fairly bullish that when the September data of inflation comes out, we will see some sort of a moderation in food prices, and that should bring down the overall retail inflation. But when you talk about core inflation, which is, with strips of food inflation and with strips of energy prices, we are still looking at fairly elevated levels. So an unchanged stance also of withdrawal of accommodation, unchanged rate, unchanged growth projection. So to my mind, no really surprises coming out of what RBI Governor just said.
All right, no big surprises coming from RBI Governor's MPC meeting, the minutes of which we just heard. Sujan Hajra, who is an Executive Director and Chief Economist, joining us at this point in time. Sujan, thanks very much for taking time out. What, according to you, stood out as far as RBI Governor's press conference is concerned? CPI inflation for the entire year, financial year 2024, is at 5.4%. This was expected by a lot of analysts to perhaps go up, given that September data could prove to be a dampener, but that hasn't happened.
Yeah, RBI is looking at the current flare in inflation to be transitory. Having said that, given the kind of projection which RBI is giving for the next financial year, that also shows that RBI feels that the part of the rise in inflation is actually structural, and it will continue for a pretty long period. So higher for longer, that's the in policy rate, which is the point globally that's likely to play out in India also. Now, I think the surprise in this, apart from the inflation projection, the surprise is the confidence of the governor on India's growth process. He is highlighting that 6.5% growth for the financial year he's maintaining, and he is actually giving a lot of data points, particularly in his footnotes, while he is supporting this view that the growth is very strong. I think, if anything, the confidence of the governor about India's growth process, that's the surprise factor today.
Okay, but higher for how much longer, Sujan? Because, rates have been in the higher territory for a fairly long time, and there were expectations that with hopefully inflation easing, we should look at a higher growth projection and hence perhaps a lower inflation outlook, and therefore a reduction in some time to come. But that reduction doesn't seem to be anywhere on the anvil right now.
See, if you look at 6.5% policy rate and 5.2% inflation projection, that means you are talking about 130 bps of real policy rate. Yeah. And if you have seen RBI's past statements, RBI wants the policy rate to be positive in the range of 100 to 150 bps. So you are bang on at that level. So long inflation doesn't come down significantly, and RBI couple of policies back clearly mentioned, while we talk about the comfort zone of 2% to 6%, RBI is not comfortable with that. RBI wants inflation around 4%. So long the inflation is not coming down to 4%, RBI will maintain a slightly hawkish stance. Obviously, RBI won't be doing a rate hike at this juncture, especially because of the global backdrop, not so much for the domestic economy. But at the same time, RBI won't budge from the current level. My sense is that at least for a 12-month, we are in a status quo position, maybe even for longer.
Okay, and this incremental cash reserve ratio to be discontinued from tomorrow. No need to suck out that excessive liquidity anymore from the banks, which I think banks saw that surge in liquidity after the 2000 notes got withdrawn. But therefore, this policy getting discontinued from tomorrow, good move at this stage?
See, RBI doesn't want the liquidity to be seriously into deficit. If you look at the interest rate of the banks, banks are raising their deposit rates faster than their lending rates. Consequently, the spread is already coming down. If you look at the credit to deposit ratio for particularly for the private sector banks, these are pretty stretched. So given all this situation, all this thing, RBI doesn't want the interest rate to rise significantly. I'm talking about the market interest rate. Therefore, slightly, despite the stance of tightening on liquidity, RBI is following more of a neutral stance already, so far as the liquidity is concerned.
Okay. And the RBI governor also spoke about reducing vegetable prices and the LPG subsidy, which is impacting the consumer directly positively by reducing the LPG prices. So in a way, giving more money in the hands of the consumer. Do you see a correlation with this move actually being fiscally prudent in an election year versus, pure economics? How do you view this?
This is one thing surprisingly most people are missing out. If you look at globally, while the monetary policy has tightened very significantly since 2022, almost all countries are maintaining a pretty loose fiscal policy stance. If you look at the fiscal deficit as a percentage of GDP in US, it's 8.6%. If you look at across countries, if you look at Europe, if you look at in India, the fiscal policy remains pretty accommodative. So while you are impacting growth by increasing the monetary policy rate, at the same time you are trying to sort of ring fence growth by maintaining accommodative fiscal policy. This is happening in India. But it's important to realize this is not happening in India alone. This is happening across the world. So that is the bigger point, and this is structurally inflationary. So that's why another thing why the inflation is not coming back to the RBI's target of 4% is because you are maintaining a loose fiscal policy. This is happening in Europe, this is happening in India, this is happening in most parts of the world with the exception of China.
But can India afford a loose fiscal policy at this stage, Sujan? Is this a prudent decision to take? When you talk pure economics, I want to leave politics aside, but is this fiscal stance a prudent one to take right now, given what is happening in the world and what is happening here in India?
If you look at you have to judge it not so much in terms of deficit, but you have to judge it from the point of view of stock of government securities. Now, as a percentage of GDP, India, the stock of government debt is not very large. On the contrary, what you have to understand, unlike in many other countries, government of India has huge amount of assets also. For example, if you look at just the listed public sector companies, if you look at the departmental enterprises like railways and all, so a significant part of our deficit is actually collateralized. And in that sense, to support growth, to maintain a slightly loose fiscal policy, and as a result, getting a little bit of higher inflation, I don't think it's a very imprudent macro policy. I would rather think this is a more balanced macro policy rather than trying to shrink the economy. This is both economically and politically a sound policy, according to my estimate.
Okay, and if we talk about core inflation, Sujan, core inflation is sticking. Now, core inflation strips off the volatility of energy prices and food prices, and yet it sticks. So, what are the other levers available at the monetary policy level or at the fiscal policy level to remove the stickiness of inflation? Because this inflation is sticking even at the core level, not just retail inflation.
No, I would have a slightly different view here. If you look at in the last 12 months, actually core inflation has come down very significantly. Before that, for a pretty long period, core inflation was hovering around 6% mark. So in a sense, core inflation has started coming down significantly. But here I want to mention that RBI does not target core inflation. The mandate of the RBI is to target the headline retail inflation. And however much we talk about core inflation, because RBI ultimately looks at inflation as a monetary phenomenon. So if you consider inflation to be a monetary phenomena, it really doesn't matter so much whether it's coming from core or non-core, because ultimately it gets transmitted. So therefore, in that sense, while RBI might draw some solace to the fact that there has been an governor specifically pointed out 150 bips drop in core inflation from the peak. But however much solace we draw from the drop in core inflation, overall the overall headline inflation remaining sticky will continue to dominate the monetary policy discourse.
Sujan, what's your estimate for core inflation in the month of September? We're still awaiting September data, and therefore we don't know what inflation numbers will be for the second quarter of this year.
The way I calculate core is slightly different from the way market calculates core. The market calculates core by stripping off food and fuel. But important to understand, in India, petrol and diesel is not part of fuel. Fuel and energy includes only electricity and and it doesn't LPG kind of thing, but it doesn't include petrol and diesel, which is included in transport services. So in my calculation, if you include that, the core inflation will be still somewhere close to 4.7, 4.8% kind of level during the month of September.
Okay, and headline inflation, given that a monsoon has been uneven, there's been difficulty there as far as, vegetable prices have come down, but pulses have remained, and the inflation at pulses level has remained elevated.
Yeah, there are very few commodities for which we are dependent on the global prices. Two exceptions are edible oil and pulses. And so therefore, it's not just the domestic supply disruption, also the increase in grain prices globally. That also impacts, because outside the subcontinent, pulses are actually cattle feeds. So the demand there comes from that particular source. So net, what I'm telling is that this is not just domestic factor. This is also a bit of international factor. And so therefore, these prices can remain elevated for a prolonged period, especially because we had seen that the pulses prices had fallen significantly in the last 24 months.
All right, and before we let you go, Sujan, RBI is estimating the GDP growth rate to remain intact at 6.5%. Is that the projection at your level as well?
My own projection is 6.2%.
Okay, 6.2%, quite in line with what World Bank said, in fact. In fact, World Bank said 6.3%.
6.3. Why, Sujan, why are you looking at a lower growth than what the RBI is projecting?
Our difference mainly coming from the manufacturing sector growth and a little bit on the agricultural side. I think still the projection on the agriculture and manufacturing is slightly higher than what the high frequency data are suggesting.
All right.
All right, Sujan, thank you very much for taking time out for joining us on this very important day.